the early 2000s, when the stock markets plunged, fear grew that economies would go into a slump. To trigger the economy back, US cut interest rates and credit became cheap. As Americans grew wary of travel, they were staying home more, and a lot of this cheap money found its way to the housing sector, and they wanted those homes to be bigger and nicer. If you were to look at the US population, you could place people into three categories: those with high incomes, those with low incomes, and those with middle incomes. The high income guy already has a house, but for a lack of a better investment, he goes ahead and buys another house. Now a person with middle income contemplates of buying a house too, but she doesn't have enough money, and that's where the bankers see an opportunity and roll out ARMs. With adjusted rate mortgages, borrowers could borrow at really low interest rates for the first few years, after which the payback amount would increase much faster when compared to a regular loan. ARMs also enabled low-income people to get houses. Bankers banked so much on rising housing prices that even ninjas were given ARMs. The housing bubble had started, caustic mortgages were spreading all over the nation. Financial intermediaries invented a way to make money from a bank's loans. They called it securtization, where a financial intermediary buys mortgage loans from various banks, packs them up and sells them to investors. These investors receive returns through the mortgage principal and interest payments paid by the borrowers. The housing market was booming, and like so many, Lucy here would have taken a housing loan of $100,000 when the house value was $100,000. When the value of the house rose to $120,000, Lucy takes another loan of $120,000 and repays the old loan of $100,000. The $20,000 difference is free money. In essence, what Lucy had done was to substitute one loan with a bigger loan without any kind of repayment. With financial innovations like these, loans were dispersed like there was no tomorrow, leading to a housing bubble. By the end of 2006, the bubble reached its bursting point as the supply of housing steadily exceeded its demand. As a result, housing prices started to flatten out in early 2007. At the same time, the ARM structure required homeowners to pay higher installments after the first few years of repayment. Homeowners therefore witnessed more than a 30% rise in their monthly payments. This resulted in large-scale defaults across the nation. Properties available for sale began to mount, refinancing frenzy began to cool, and the bubble bursted. By this time, most of the financial institutions had bought into these securitized home loans, and as their value dropped, all these institutions experienced a liquidity shock. Liquidity of an asset is the ease with which it can be converted to cash of equal value. An investor always demands a return which is commensurate with the risk of an investment. Liquid assets like gold are less risky and hence offer lower returns over time, while a higher return is expected of an illiquid and hence riskier asset like a house. Companies ensure that a part of their assets are liquid enough to meet their short-term payment requirements. The rest are invested in less liquid assets like housing in expectation of higher returns. Let's look at a simple balance sheet of a bank. A typical bank accepts deposits, borrows from other banks, and of course has its owner's wealth. It maintains a fraction of this wealth as cash to meet its short-term obligations, invests in less liquid assets like corporate bonds, and into highly illiquid assets like mortgage securities. The housing bust starts to erode the mortgage securities value. As a result, the shareholders' wealth equally comes down, placing the bank in a risky position. This pushes the lending banks to call their loans in, with increasing chances of a default, even depositors start to withdraw their deposits. With limited cash reserves, the banks scurry to raise sufficient cash to satisfy these lending banks and depositors. To raise cash, the bank starts to sell publicly traded corporate bonds, which are relatively liquid compared to its other assets. As more bonds are sold in the market, the demand for these bonds starts decreasing, pushing their prices down. This creates problems for other banks in the market, as the value of the corporate bonds they hold also declines. In short, they find themselves in the same position as the first bank, and the vicious cycle repeats. What originally started as a simple decrease in the values of illiquid assets has quickly spread to the corporate bond markets and to other asset classes. As more banks get into the spiral propagating the liquidity shock, the entire financial system finds itself amidst a major crisis. When banks face a liquidity shock, they usually shut down some of their lines of business, or they enforce stricter lending policies, which means that only high quality borrowers get credit. These two actions result in an undersupply of credit in the economy called a credit crunch. Business growth slows down and many companies go under. Thus, liquidity shock, which originated in the financial sector, now begins to affect the non-financial economy. This is how a shock from Wall Street gets transmitted to Main Street. To summarize, lower interest rates led to the housing boom. Innovative products like ARMs led to the housing bubble. Refinancing and the frenzy in the housing market led to an oversupply of housing assets. The flattening of housing asset values resulted in a liquidity crisis. As the liquidity crisis spread deep into the banking system, which led to a curtailed lending environment, eventually leading to a credit crisis.